Hey there, curious minds. Welcome back to the Deep Dive. We're the place where we slice through stacks of information, try to get straight to those aha moments. Today, we're diving headfirst into a topic that, okay, it might sound a bit accounting days, maybe a little dry on the surface. But trust me, it's way more fascinating and absolutely crucial to how businesses actually run day to day. We're going on an adventure through what's called the expenditure cycle.
Mhm.
Just imagine, right? Every single time a company buys something. And I mean, I think maybe a handful of new pens for the office supply cabinet, or maybe it's a multi-million-dollar piece of specialized machinery, maybe it's software, a subscription. For every single one of those purchases, there's this incredibly detailed, often really intricate dance of internal controls and checks happening behind the scenes.
Mhm.
It's all geared towards making sure money is spent wisely, correctly, and legitimately. It's kind of like the invisible architecture that supports the whole financial stability of the company. It basically keeps businesses from, well, spiraling into financial chaos.
It truly is. It's such a foundational process for any organization. Doesn't matter if it's a tiny startup or some massive multinational corporation. Getting this cycle right, really mastering it, is absolutely key to ensuring financial integrity. And not just that, but preventing costly errors, safeguarding against internal theft, or even outright fraud. Understanding this cycle gives you this unique insight into how businesses truly function at their very core, way beyond just the products or services they offer to the world.
Absolutely spot on. So if you've ever wondered how companies manage their spending with, well, seemingly such precision, or how they prevent mistakes that could potentially cost millions, or maybe how auditors even begin to check if everything's above board, trustworthy, this deep dive is definitely for you. We're going to break down every single step. We'll try to make it super easy to understand and really show you exactly why each little piece of this puzzle matters so much. Okay, let's truly unpack this thing and see what makes it tick. Okay, let's start with the big picture then. What is the expenditure cycle, really, at its heart? Simply put, it's the entire continuous loop a business goes through to acquire all the goods and services it needs just to operate. Everything from paper clips and coffee for the break room to complex software licenses or raw materials for manufacturing. And then, crucially, the second half of the loop, paying for them. So it's this series of interconnected steps, seeing a need, making the purchase, confirming you got what you ordered, and then finally settling that bill.
Exactly. And like you touched on earlier, the absolute cornerstone, the very foundation holding this entire cycle together, is robust internal controls. Think of them like a sophisticated alarm system for the company's finances,
Right.
or maybe steel guardrails on a highway, vital safety nets. They're all designed to protect a company's assets. Without strong controls, a business is just incredibly vulnerable, really exposed. They could easily fall prey to overspending, maybe paying for things they didn't actually receive, or unfortunately becoming a target for internal theft. Just imagine for a second a company where, say, any employee could just order whatever they wanted online using a company card and then maybe also approve the payment for it themselves. It would lead to financial disarray, probably massive losses, incredibly quickly, wouldn't it?
Oh, absolutely. Total chaos.
Right. So this is precisely where the why it matters really comes into sharp focus. These controls aren't just, bureaucratic hurdles or red tape designed to slow things down. No, they're meticulously designed, often over years of experience and learning from mistakes, to mitigate those specific risks. They ensure the company's resources are used efficiently, ethically, and maintain that crucial trust with everyone involved: investors, lenders, employees, customers.
That makes perfect sense. So we're essentially building this fortress of financial integrity, maybe brick by brick, control by control. Okay, let's break down the purchasing process itself. You mentioned phases. Let's look at the first phase, purchasing, and its essential stages, or pillars, as the outline called them, each with its own critical controls, acting like those foundational building blocks. All right, pillar one. This is where it all begins, right? The very spark of a need somewhere inside the organization. Let's say a specific department, maybe marketing, needs a new subscription to some analytics software, or engineering needs specialized components, or the admin team needs, I don't know, a bulk order of printer paper. So they don't just grab a company credit card or call up a vendor. No, they send what's formally called a purchase requisition. And this isn't just like a casual email saying, hey, can we get this? Yeah, ow, or a sticky note slapped on someone's desk. It's way more formal than that. It's a properly approved document. And here's a key phrase. It's serially numbered. This formal request travels directly to the purchasing department. The term serially numbered is really key here, isn't it? It means every single requisition gets its own unique sequential identifier. like giving every single request its own traceable barcode or tracking number.
Precisely. That serial number makes it accountable and trackable from the absolute moment it's created until its ultimate resolution, whether it gets approved and ordered or maybe denied. It ensures no request simply disappears into a black hole or gets overlooked in someone's inbox.
Right. Accountability.
And what's truly fascinating here, and maybe the first critical control right at this very first step, is this principle. The department that needs the asset or service, they should not have the authority to actually place the purchase order itself.
Okay. So the people asking for it can't be the ones actually buying it.
Exactly. It's a fundamental principle we'll keep coming back to. Segregation of duties. Why is this so vital right from the start? Because if the same department or even the same person could both request and order, it would create this gaping hole in internal control, a massive vulnerability. Imagine, say, a departmental manager ordering a super high-end espresso machine, maybe justifying it vaguely, but really wanting it for personal preference, not a genuine business need. And then if they could also approve that order themselves, well, that just throws the doors wide open for unauthorized spending, unnecessary purchases, maybe even excessive spending. It could easily facilitate misuse of company funds.
I see. So separating the requesting function from the actual ordering function builds that very first line of defense.
Spot on. It's a defense against wasteful or improper spending. This simple separation is paramount from day one. It acts as this invisible but incredibly powerful barrier.
Okay, so pillar 1 was the request. Now, pillar 2, purchase orders. Once the dedicated purchasing department receives that formally approved requisition, their first priority isn't just to jump online and buy it immediately. Their job is to ensure the company gets the absolute best deal possible, right?
That's generally their mandate, yes. For significant purchases especially. This often means actively soliciting bids or quotes from various qualified suppliers. They're doing their homework, their due diligence, meticulously comparing prices, sure, but also quality, delivery terms, vendor reliability, maybe warranties, all that stuff. They're trying to ensure the company obtains the best possible value, not just the lowest price necessarily, for the goods or services requested.
Makes sense. Value over just cheapness. So after this careful consideration, and once the chosen supplier and the terms are properly approved, which might involve a purchasing manager or maybe even someone higher up for really big purchases, the purchasing department then creates the official purchase order, or PO.
Correct. And this document, the PO, it isn't just a simple note either. It's the formal, often legally binding commitment from the company to the vendor. It meticulously details everything. The description of the goods or services, the precise quantity needed, the agreed-upon price per unit, any specific delivery instructions, payment terms, and really any other relevant information. It should leave absolutely no room for ambiguity or misunderstanding later on. It serves as the definitive record of the company's commitment to buy.
So it's the official green light to the vendor.
Exactly. And for control purposes, just like those requisitions we talked about, these purchase orders are also pre-numbered, usually serially. This continuous numerical sequence is vital because it ensures that every single purchase order issued is accounted for. It prevents any from being lost, maybe ignored, or potentially hidden if someone was trying to do something shady.
Okay, pre-numbering again. Seems like a recurring theme.
It's a basic but powerful control. But here's where the system really illustrates its, well, maybe brilliance isn't too strong a word, how internal controls create this robust web of checks and communication. Multiple copies of the single PO are created and then strategically distributed to different independent departments. This ensures that everyone who needs to be aware of the transaction and who needs to perform their specific part in the cycle has the necessary information. It connects the dots.
Okay. So where do these copies go?
Typically breaks down like this. One copy immediately goes back to the requisitioning department, the team that originally asked for the stuff. They receive this copy as confirmation that their request is actually being acted upon. And it usually gives them an estimated timeline for when to expect delivery, so they're kept in the loop.
Good. So they know it's happening.
Yes. Then another copy is sent directly to the vendor. This is their official instruction, the legal commitment from the company to buy. It authorizes them to ship the goods or provide the agreed-upon service.
The order itself makes sense.
Third, crucially, a copy goes to the receiving department. This copy acts as their heads up. It lets them know what specific goods to expect, who they're coming from, and roughly when. It's their pre-notification to prepare for incoming shipments, maybe clear space, schedule staff.
Okay, so receiving knows what's coming.
Precisely. And finally, the fourth copy we'll highlight goes to the accounting department, usually specifically to the accounts payable section. This is absolutely vital because it formally notifies them that a future payment obligation, a liability, will be coming their way eventually. It allows them to anticipate and plan for the eventual cash disbursement. They can start preparing their records for the upcoming liability even before an invoice arrives.
Wow, that's incredibly clever. It really is like a built-in communication network, making sure all the right hands know what the left hands are doing, essentially. So following that logic, if for any reason a purchase order has to be canceled, maybe the business need evaporates or the budget gets cut unexpectedly, or perhaps the vendor simply can't fulfill the order, what happens to all those copies floating around?
Great question. If a PO is canceled, all those distributed copies need to be systematically recalled, physically gathered up or digitally voided, and then filed together, usually with the original canceled PO. Why the meticulous recall? Why not just trash them? It goes right back to that pre-numbering system. Every single purchase order number in that sequence, whether it was fulfilled perfectly, partially fulfilled, or completely canceled, must be accounted for, documented. There can be no missing links, no gaps in the numerical sequence. That's a fundamental control designed to prevent unauthorized orders from maybe slipping through the cracks or perhaps being disguised later as legitimate. It's all about ensuring absolute transparency and traceability for every single financial commitment the company makes, even the ones that don't go through.
Got it. No loose ends, every number accounted for. Okay, so we've ordered via PO now for Pillar 3. Receipt of goods or services. With all that careful planning and documentation, the moment arrives when, the rubber meets the road, the actual delivery of the goods.
Yeah.
Or maybe the start of the service, that copy of the purchase order that was sent to the receiving department that now acts as their official authorization to accept the incoming delivery, right?
That's correct. They know exactly what to expect, who it's from, because they received that pre-shipment PO copy we discussed. It gives them the context for the delivery. But here's where another really clever trick, a specific control, often comes into play for even stronger accountability and diligence on their part.
What's that?
Ideally, the copy of the PO sent to the receiving department should not indicate the quantity ordered.
Really? It doesn't say how many they're supposed to get.
Often, no. This is commonly referred to as a blind copy of the purchase order, or sometimes a blind receiving report is used instead, which serves the same purpose. Why do this? Why leave off such a seemingly crucial piece of information? Well, it's actually a brilliant piece of, you could almost say, psychological engineering and control design. It forces the receiving department personnel to physically count the goods upon arrival. They can't just glance at a pre-filled form that says 100 units received and simply sign off without really checking.
I see. If the number's already there, it's tempting to just assume it's correct.
Exactly. There's a higher human tendency to take shortcuts, especially when busy. They might just visually confirm the shipment looks about right, maybe do a spot check, but not perform an accurate count. And that's how you potentially miss a short shipment from the vendor, or maybe even an overshipment. By making them count independently from scratch, it drastically reduces the chance of the company paying for items that weren't actually received or were short shipped. It ensures the company only pays for what it truly gets and prevents potentially costly discrepancies down the line. It preempts those human shortcuts, acknowledging that people are often less likely to be super diligent if a pre-filled answer is readily available.
That's really smart. So beyond just counting, what else does the receiving department do?
Good point. It's not just about quantity. They also meticulously match the description of the goods they received to the description on their copy of the purchase order. This confirms they received exactly what was specified and ordered the right model number, the right color, the right specifications. And, just as importantly, they thoroughly examine the physical condition of the goods. They check for any damage incurred during shipping, any obvious defects. After all, if you ordered 100 perfect widgets, you don't want to accept 90 broken ones and 2 that are the wrong model, right? This quality and condition check is another vital layer of verification at the point of entry.
Makes total sense. You got to check the quality too.
Absolutely. So once they are satisfied with the count, the description match, and the condition of the goods, the receiving department prepares their own document. This is called a receiving report. This document details precisely what was received, the quantity, when it arrived, which vendor it came from, the related PO number, and its condition. Any discrepancies or damages would be noted here. This receiving report is then promptly forwarded directly to the accounting department, usually accounts payable again. And this receiving report is absolutely crucial downstream because it provides independent, objective verification from a totally separate department that the goods have indeed arrived and are acceptable. It's a critical piece of evidence for the payment process later.
Okay, so receiving generates proof that the stuff arrived okay. What happens to the actual stuff?
Ah, the physical goods themselves. Well, once they're checked in, they are typically forwarded to the original requisitioning department, the people who initially requested them, so they can finally put them to use and fulfill whatever original need sparked that first purchase requisition. This handoff completes the physical receipt part of the expenditure cycle. And now, the financial paperwork really gears up for the next major phase.
Okay, so the goods are received. They've been meticulously verified by the receiving team. The baton now passes firmly to the accounting department. This is where the financial gears really start turning, isn't it?
Mhm.
Managing the payment process, formally recognizing the company's new obligation.
That's exactly right. Welcome to Phase 2, Accounts Payable, or AP. This department plays a pivotal role in ensuring payments are accurate and legitimate. Hashtag 2.1, recording the payable the debt is acknowledged.
Now, you mentioned earlier that the accounting department already got a copy of the purchase order way back when it was issued, so they kind of know a future cash disbursement is coming down the pipeline. But you also said they don't record it right away.
Correct. They have the heads up from the PO, but crucially, they won't actually record the formal liability, the debt owed to the vendor, often referred to as an accounts payable, until they receive that official receiving report from the receiving department. This delay isn't just about waiting for paperwork, it's a deliberate, crucial control step. They're waiting for independent confirmation from a completely separate department, remember, that the goods are actually in the company's possession and in acceptable condition. Basically, the rule is no receiving report, no recorded payable, and therefore no payment should be processed. It prevents paying for goods that never showed up or were rejected upon arrival.
Got it. Proof of receipt is the trigger.
Precisely. And here's where that crucial three-way match, which is a real cornerstone control in the entire expenditure cycle, often happens, or at least the preparation for it begins. The accounting department, specifically AP, meticulously compares three key documents, almost like cross-referencing three independent pieces of evidence to confirm a single fact before they acknowledge the debt. Those three documents are, number one, the vendor's invoice. This is the bill from the supplier stating what they claim the company owes them. Number two, the purchase order. This confirms what the company originally agreed to buy and the terms. And number three, the receiving report. This confirms what was physically received and accepted.
Invoice, PO, receiving report, the three legs of the stool.
You could think of it that way, yeah. This rigorous comparison confirms key details across all three documents: the quantity of items, the description of items, and the price per item. For example, if the vendor's invoice charges for 100 units at $10 each, but the receiving report clearly shows only 90 units arrived, or maybe the purchase order shows the agreed price was only $9 per unit, that discrepancy is immediately flagged, and it needs to be investigated and resolved before any payment is approved. Maybe they need to contact the vendor or check with receiving again.
So this matching process stops errors before money goes out the door.
Exactly. This multi-document matching is an incredibly powerful internal control because it directly prevents payment for charges that might exceed what was ordered or what was actually received. It also catches potential pricing errors on the invoice. It's essentially a triple check designed to prevent errors, accidental overpayments, or even potentially fraudulent invoices from being processed and paid. Only once this precise match is successful or any discrepancies are resolved and documented does the accounting department formally record the goods as received into inventory, if it's inventory, of course, and simultaneously officially record an accounts payable. That recording action is essentially the company formally acknowledging, yes, we owe this vendor this amount of money. It's the IOU hitting the official books. Hashtag 2.2. Approving invoice for payment and recording payment, the green light.
Okay, so the payable is recorded after the three-way match confirms the basics, but the invoice still needs to be formally approved for payment, right?
Yeah.
What does that involve?
Yes, absolutely. Recording the payable is step one, but the invoice needs a final definitive green light before the check is cut, so to speak. When the actual vendor invoice arrives, and sometimes it comes much later than the goods, or maybe even before them, the accounting department doesn't just process it immediately based on the earlier match. They give it a final, thorough stamp of approval. And this isn't just a quick glance, it should be a meticulous final check.
Okay, so what's involved in this final check? Is it more matching?
Often, yes. This is sometimes referred to as the ultimate match that culminates in the formal payment authorization. The accounting department approves the invoice for payment by rigorously matching it, yes, with the purchase order and the receiving report again, but sometimes they even go back and match it with the original purchase requisition as well.
Wow, a four-way match. Requisition, PO, receiving report, and invoice.
Exactly. This comprehensive four-way match ensures everything aligns perfectly across the entire transaction history, from the initial documented need all the way to the final bill before any payment is actually initiated. They also perform other critical checks at this stage. They ensure the invoice amount is mathematically correct, rechecking the extensions, the footing, the total sum. And crucially, they check for any applicable purchase discounts, terms like 210 net 30.
Right, where you get a discount for paying early.
Precisely. AP needs to identify those opportunities and ensure the correct discounted amount is paid if the company intends to take the discount. Missing those discounts consistently can actually add up to significant money over time. They also need to account for any purchase returns or allowances that might have happened after the initial receipt, which would reduce the amount owed. Only when all these checks are satisfied, the four-way match holds up. The math is correct, discounts are considered, returns are factored in. Only then is the invoice formally stamped or electronically flagged as approved for payment.
Okay, so that's the final blessing from accounting.
It is. And then, just to close the loop on the accounting side, once that payment is actually made by the treasurer in the next phase, phase 3, the accounts payable department gets notification of the payment. They then reverse that accounts payable entry in the accounting system, essentially debiting accounts payable and crediting cash. This signals that the debt, that IOU to the vendor, has been definitively settled and is no longer an outstanding liability.
Phase 1, we requested. Phase 2, we ordered, received, matched, and approved. Now Phase 3, cash disbursements. It's time for the final act in the expenditure cycle, actually paying the bill, getting the money out the door to the vendor.
That's it. This is where the cash actually flows out of the company. And just like the previous stages, strong controls are absolutely vital here. Ideally, for the sake of a strong control environment and a clear audit trail, invoices should always be paid by check or by a similarly traceable electronic funds transfer (EFT) method. While electronic transfers are obviously increasingly common today, the underlying principle remains exactly the same. You need to create an auditable paper or digital trail. That trail needs to clearly show who approved the payment internally and who actually executed the payment, releasing the funds. Traceability is key.
Okay, traceability makes sense. What's the big control here?
The absolute critical control in cash disbursements is, again, segregation of duties. The functions of approving the payment documentation, which happens in AP, as we just discussed, and signing the checks or initiating the EFTs must be strictly segregated, kept in different hands.
Why is that specific separation so critical?
Because it means the individual or department who meticulously reviews the documents and authorizes a payment cannot also be the one to physically sign the check or electronically release the funds. Think about it. If the same person held both authorities, they could potentially create a completely fictitious invoice, approve it themselves, and then pay themselves or an accomplice, effectively stealing from the company with potentially minimal risk of immediate detection. This separation acts as an incredibly powerful deterrent against fraud. It also serves as a vital mechanism for its early detection, because now at least two separate people or departments are involved in the process.
Got it. So the approver can't be the payer. So after all those meticulous checks in AP, the accounting department, specifically the accounts payable team, prepares what are often called approved voucher packets. What's in those?
Good question. That voucher packet is essentially the entire fully supported history of that specific transaction, all bundled together. It typically contains the original vendor invoice, the supporting purchase order, the crucial receiving report, and sometimes even the initial purchase requisition. All the documents we've been talking about. This complete package, with all its stamps of approval and evidence of matching from AP, is then forwarded, usually physically or sometimes electronically, to the Treasurer's Department, or whoever holds the cash disbursement function. This ensures the treasurer, the person with custody of the cash, has all the necessary, independently verified documentation right in front of them to confirm the legitimacy of the payment before they sign anything or initiate any transfer. They aren't just signing checks blindly.
Okay, so the treasurer gets this whole package. What do?
The treasurer, or an authorized person within their department, takes these approved voucher packets. They should perform a final review, maybe not as detailed as AP's, but a review nonetheless to ensure all the key documents are present and properly authorized. Then and only then do they prepare, sign, and mail the actual checks to the vendors. Or, in an electronic system, they would initiate the approved EFT payment. But here's another clever and absolutely critical control that should happen immediately right after the payment is made or initiated.
Another one. Okay, what is it?
Right after payment, the treasurer, or the check signer EFT initiator, must cancel or clearly mark as paid all the supporting documents within that voucher packet, the invoice, the PO, the receiving report.
Cancel them. Yeah. What does that achieve?
It's crucial to prevent them from ever being used again, accidentally or intentionally, for a duplicate or fraudulent payment. Imagine if those original documents weren't canceled or marked paid. A dishonest employee, or maybe even just a very disorganized system, could easily allow the exact same invoice and its supporting papers to be resubmitted later. That could lead to the company inadvertently paying for the same goods or services twice. Or even worse, it could facilitate a sophisticated scam where someone keeps resubmitting legitimate-looking paid invoices for payment again and again. By canceling them, which often means physically stamping them paid with the date and check number, or maybe perforating them with a paid mark or securely marking them as paid in a digital workflow system, it's a simple yet incredibly effective way to ensure that payment only happens once for any specific legitimate transaction. It breaks the potential reuse cycle.
Okay. So canceling stops double dipping.
Exactly. It's a finality control. After the payment is made and the documents are canceled, these now paid voucher packets are then returned to the accounting department. Accounting then does the final posting of the payment into the general ledger, which, as we mentioned, reduces the account's payable balance and the company's cash balance. And then those complete paid and canceled voucher packets are filed away permanently, creating a complete indelible audit trail for that entire transaction from cradle to grave. So if we try to connect all these individual steps we've been walking through, these numerous checks, balances, approvals, matching procedures back to the bigger picture, they all really come back to and are designed to reinforce one fundamental overarching principle of internal control: segregation of duties, sometimes called separation of duties.
We've mentioned that a few times. Can you maybe summarize what that really means in this context?
Sure. At its core, segregation of duties means that no single person, or even a single department, should have complete end-to-end control over a transaction from its beginning to its end. Especially financial transactions, it's about consciously designing a system, a workflow, where the work of one individual or group automatically checks or complements the work of another. This inherently fosters a robust network of accountability, and it significantly reduces the opportunity for both unintentional errors to go uncaught and for intentional fraud to be perpetrated successfully.
Okay, making sure no one person has too much power over a single process.
Precisely. And in the expenditure cycle specifically, we see three absolutely key functional areas where this segregation of duties is crucial for effective internal control, for preventing major financial mishaps. These are often summarized as ARC. ARCA is for authorization. This function involves initiating and approving the transaction. In our cycle, this is typically handled by the purchasing department, approving the PO, or maybe even the original requisitioning department, approving the need. They get the permission, they initiate the spending, they select vendors, always within established company policies and budgets. They decide what to buy and who to buy it from.
Okay, A for authorization. Got it.
R is for record keeping. This responsibility falls squarely on the accounts payable team and the broader accounting department. Their core role is to accurately track the transaction in the company's financial books and records. They process the invoices, perform those critical three-way and four-way matches we talked about, record the payable, and ensure that the financial statements accurately reflect the correct liabilities and expenses. Critically, they should not be the ones initiating the purchase, nor should they be handling the physical cash or signing checks.
R for record keeping. Makes sense. Keep them separate from A.
Yes. And C is for custody. This refers to having physical control over assets involved in the transaction. In the expenditure cycle, the receiving department has initial custody of the purchased items once they arrive, ensuring they are properly secured, counted, inspected, and then forwarded appropriately. And, perhaps most importantly in this cycle, the treasurer's department has custody of the cash. They are the ones who actually disperse the funds, signing checks, or initiating those electronic transfers. They handle the physical assets, goods, or the liquid funds, cash.
ARC, authorization, record keeping, custody. So just to reiterate and make sure I've got it.
Yeah.
If one person couldn't, for example, both authorize a purchase order, A, and also sign the check, C, to pay for it.
Correct. Or if the person who records the payable couldn't also authorize the purchase, A, or have custody of the cash,
Then it drastically reduces the opportunity for fraud or even just significant errors to slip through.
Exactly right. Think of it. If the same person who records a payable also has custody of the cash, they could potentially create a fake invoice for a non-existent vendor, record a fictitious liability in the books, and then pay themselves or an accomplice, all without any independent oversight built into the process. By intentionally building in these independent checks, authorization by one department, recording by another, and custody of assets, goods, or cash by yet another, it creates a system where perpetrating a significant fraud would likely require collusion between multiple individuals in different departments. And collusion is inherently far more difficult to achieve, riskier to maintain, and therefore much less likely to happen than fraud perpetrated by a single individual with too much control. It's really about making it inherently harder for things to go wrong, whether those things are honest mistakes or deliberate malicious intent. It's a design philosophy that prioritizes financial resilience and integrity, sometimes even over maximum efficiency or convenience.
Okay, well, so we've just walked through how companies painstakingly build this really intricate system of controls, this sort of financial fortress around their spending. It's impressive, but a system, no matter how well designed it looks on paper, is only as good as its actual implementation and how consistently it's followed day in, day out. So how do we know it's actually working as designed?
Consistently.
Effectively, are people actually following these procedures? This is precisely where auditing comes in, right? It's that rigorous process of ensuring that everything we just discussed, all those controls, all that segregation is not only in place on paper, but is actually functioning properly in reality. Okay, now here's where, for me at least, it gets really interesting. Peeking behind the curtain of an actual audit.
That's exactly right. Auditors don't just, take the company's management word for it that these internal controls are effective. They can't. Their professional standards require them to gather evidence. So they perform specific, often quite detailed, procedures to obtain concrete, objective evidence. Evidence that these controls are not only well designed in theory, but are also operating effectively throughout the entire period they're auditing. This process of testing the controls provides the auditors with the basis for assessing the risk of material misstatement in the financial statements. It helps them determine how much they can rely on the company's own systems. Ultimately, it's about building trust, yes, but it has to be verifiable trust supported by tangible evidence gathered through testing.
Okay, trust but verify, the classic auditor's motto, perhaps. Let's make this concrete. Can we look at a few examples of how these theoretical controls we just spent time discussing are actually put to the test in the real world? How do auditors check if that financial fortress is truly standing strong against risk, department by department?
Absolutely. Let's walk through some examples, linking the control objective to the typical audit test procedure. Okay, starting back at the beginning with the requisitioner. Remember, their key control is preparing those pre-numbered requisitions and, crucially, getting proper approval from a manager or budget holder before it goes anywhere. So what does an auditor do? They would likely inspect a sample of those purchase requisitions. They'd physically look at them, checking for that required management signature or electronic approval stamp, making sure they weren't just informal notes or emails. They might also observe the procedures in the department, literally watching how requisitions are prepared, numbered, and processed. This helps them ensure that all requisition numbers are accounted for, checking for any suspicious gaps in the numerical sequence that might indicate missing or perhaps unapproved requests. These tests primarily help confirm the authorization assertion for purchases and the completeness of the requisition tracking.
Okay, inspect and observe for requisitions. Makes sense. What about purchasing?
Moving to the purchasing department. Their key controls include issuing those pre-numbered purchase orders, maybe obtaining competitive bids for larger items, getting supervisory approval, and sending out those crucial copies to the vendor, receiving, and accounts payable. Here, the auditors would similarly inspect a sample of purchase orders. They'd look for evidence of approved supervision, for instance, checking that a purchasing manager signed off on the chosen vendor and the terms, especially for significant amounts. They would also likely observe the procedures used by purchasing staff to account for the pre-numbered sequence of purchase orders, again ensuring no POs are missing from the sequence or were perhaps issued without proper documentation or record. These tests help verify the authorization of the purchase commitment and the proper initial recording or tracking of that commitment.
Inspect and observe again, focusing on the POs and approvals. Got it. Now, receiving.
Okay, for the receiving department. A key control here is preparing that detailed pre-numbered receiving report upon arrival of goods. And sometimes getting a signature from the requisitioning department when the goods are handed over, confirming they reach their final internal destination. Auditors would inspect a sample of receiving reports, looking for those signed receipts from the end user department if that's part of the process. That signature provides clear, independent proof supporting the existence assertion that the goods actually arrived and were handed off internally. They might also observe the actual performance of procedures by the receiving clerk, watching them physically count goods, inspect for damage, and prepare the report. This gives them direct evidence of the control being performed. And a really powerful test here, one we often use, is to trace a sample of receiving reports. We select some receiving reports from their pre-numbered file, and then we trace them forward through the system, linking them to the corresponding purchase order, the original requisition, the eventual vendor invoice, and finally verifying that the transaction was correctly entered in the purchase journal and the accounts payable master file. This tracing primarily tests the completeness assertion for recording liabilities, ensuring that everything that was physically received was properly recorded in the company's books.
Okay, tracing from receiving forward checks completeness. That makes sense. What about accounts payable, where all that matching happens?
Right, accounts payable, AP. Their critical controls revolve around that three-way or four-way matching of documents, the vendor's invoice, receiving report, PO, maybe the requisition, and rigorously checking mathematical accuracy before approving payment. Auditors have several tools here. They would inspect a sample of voucher packets. They look for the presence of all the required supporting documents and, importantly, look for evidence of those independent checks, like maybe a calculos, verificados stamp, or initials indicating calculations were double-checked by someone else in AT. They might also observe AP clerks performing the matching process or reperform some of the accounting calculations themselves. For instance, taking an invoice and re-adding the line items or recalculating the discount to see if they get the same result as the company. This directly tests accuracy. They'd also likely physically account for the numerical sequence of vouchers prepared by AP, again testing for completeness, ensuring all approved invoices resulted in a recorded voucher. And a very common direct test here is to vouch a sample of recorded transactions. Auditors select entries from the purchases journal or the AP ledger, and then go backward. They vouch these recorded entries back to the underlying supporting documents in the voucher packet, invoice, APO, receiving report. This vouching process, going from the books back to the source documents, primarily tests the existence or occurrence assertion, proving that the recorded liability or purchase transaction truly exists, is legitimate, and was properly supported by valid documentation.
Okay, vouching goes backward to check existence. Tracing goes forward to check completeness. Got that distinction. And finally, the treasurer.
Finally, the treasurer's function, responsible for the actual cash disbursement. Their key controls involve reviewing the approved voucher packets for completeness before payment, preparing pre-numbered checks or traceable EFTs, ensuring only authorized signatories actually sign checks or approve transfers, and critically, canceling all supporting documents immediately after payment. Auditors would likely observe the performance of these independent checks by the treasurer or their staff. They might watch them review voucher packets or cancel documents. They would inquire about their specific procedures for safeguarding blank checks, controlling signature plates or electronic access, and the process for canceling documents. They'd select a sample of paid checks or EFT records for testing and inspect the signatures or electronic authorizations, verifying they were made by a properly authorized person according to the company's bank mandates or internal policies. And importantly, they would observe the actual cancellation of vouchers by the check signer or EFT initiator to ensure those documents truly cannot be processed again for duplicate payment. These tests collectively provide strong evidence that the payment process itself is properly controlled, payments are accurate, authorized, and importantly, the risk of double payment is minimized.
Wow, that's quite a range of tests. Inspecting, observing, tracing, vouching, reperforming, inquiring.
It is. This rigorous testing process helps auditors gain confidence, or sometimes identify weaknesses, in the entire system of internal controls over the expenditure cycle. If the controls are found to be strong and operating effectively throughout the period under audit, it generally provides a higher level of assurance about the reliability of the company's financial records related to spending and payables. And this finding, in turn, often allows the auditors to reduce the amount of further, more detailed substantive testing they might need to do on the actual account balances themselves, like the final accounts payable balance. It's a risk-based approach. Strong controls generally mean a lower assessed risk of material misstatement in the financial statements, which can influence the nature, timing, and extent of other audit procedures. Now, shifting focus slightly from testing the controls to testing the actual financial statement balances themselves, let's talk specifically about auditing accounts payable. This is a really crucial area, and there's a very important concept auditors always keep in mind here. For accounts payable, the passkey, the main thing to worry about, is that the completeness and accuracy assertions are generally much more relevant and carry a significantly higher inherent risk than, say, the existence or rights and obligations assertions.
Completeness and accuracy are more relevant than existence. Why is that?
It's a fundamental concept, really, driven by natural business incentives. In accounts payable, the risk of understatement, meaning liabilities are missing or stated too low, is almost always considered much greater than the risk of overstatement. Think about it from a management perspective, especially if maybe the company is under pressure or wants to look good. There's often a natural incentive, conscious or subconscious, to make the company's liabilities look smaller, not larger. Lower liabilities can make the company appear financially healthier to investors, lenders, or potential buyers. This means auditors are intensely focused on ensuring that all legitimate liabilities are truly included on the books at year-end, not just the ones the company might be easily willing to show. They're looking for what might be missing.
Ah, okay. The incentive is to hide debt, not inflate it. So auditors focus on finding the hidden stuff.
Exactly. It's not just some accounting quirk. It's a direct reflection of potential management bias or simple error leading to understatement. Auditors know this inherent risk exists, which is why their focus often flips compared to auditing assets like accounts receivable, where overstatement might be the bigger concern. For payables, it's not just about verifying what's recorded, but actively searching for what might be missing.
Okay, so if completeness is the big one for accounts payable, how on earth do auditors make absolutely sure that all payables, every single legitimate debt the company owes, no matter how small or how recently incurred near year-end, are actually included on the balance sheet? That sounds like trying to find a needle in a haystack sometimes.
It absolutely can be challenging, and it requires a very methodical, planned approach. It's one of the trickier assertions to get comfort over. First, they'll perform some basic reconciliation checks. They'll obtain the company's detailed accounts payable listing, which should be an itemized list of all amounts owed to individual vendors at the balance sheet date, and agree the total of that listing to the summary balance shown in the general ledger control account for accounts payable. This just ensures the detailed subledger matches the main financial record book.
Okay, basic matching first.
Yes. Then, the primary and absolutely vital procedure here is to perform what's specifically called a search for unrecorded liabilities. This is where auditors really put on their detective hats, getting, as you said, Sherlock Holmes level, curious about what might be lurking just off the books.
A search for unrecorded liabilities. How exactly do they conduct that search?
There are several ways they approach this, often in combination. A very common technique is for auditors to select cash disbursements checks paid or EFTs made after the company's year-end date, say for payments made in January or February of the new year if the company's year ends December 31st. They then meticulously examine the supporting documentation for these subsequent disbursements. They're looking closely at things like the receiving reports and vendor invoices attached to those payments. What are they specifically looking for? They're looking for items where the receiving report date or the service date on the invoice clearly indicates that the goods were received or the service was performed before the balance sheet date, for example in December, but the liability wasn't recorded until the next period, January. That's a classic unrecorded liability at year end.
Ah, so they look at payments made after the year ends to find expenses that belong in the year that just ended.
Precisely. It's a backward look from subsequent payments. They might identify these potentially relevant subsequent payments by carefully reviewing the cash disbursements journal for January and February, or maybe by scrutinizing the bank statements for those months, looking for significant or unusual payments to vendors. They might also review the voucher register for items processed shortly after year end. They also perform other related procedures. They often examine documents that are still open or unprocessed shortly after year end. This could include looking at the file of open purchase orders, the file of receiving reports that haven't yet been matched to invoices, or the file of unmatched vendor invoices that have arrived but haven't been processed yet. They might also look at vendor statements received by the company in January that show balances owed as of December 31st. This thorough backward and forward look around the year-end date helps them systematically uncover those potentially hidden liabilities, which, if significant, could otherwise cause the financial statements to be materially understated, painting a misleadingly rosy picture of the company's financial position. It's all about finding what the company should owe based on when the economic activity occurred, even if they haven't formally acknowledged it on their books yet.
Okay, so the search for unrecorded liabilities tackles completeness. But beyond just making sure everything's included, How do auditors ensure the numbers themselves, the amounts listed for each payable, are right? Are they truly accurate? Do they reflect things like applicable discounts, correct math, maybe proper currency conversions if it's an international business?
Good question. Ensuring accuracy, or more formally, the assertion of valuation, allocation, and accuracy is also crucial. Auditors follow several standard procedures here. As mentioned before, they obtain that detailed accounts payable listing or schedule. They then foot the listing, which is auditor jargon for adding up all the individual vendor balances to ensure the grand total listed by the company is mathematically correct. Simple addition errors can happen. They then agree this footed total to the general ledger control account for accounts payable, confirming again that the detailed listing ties into the company's main financial records.
Footing and agreeing. Basic checks.
Basic but necessary. Then, a very effective procedure, particularly for accuracy, is to obtain a sample of vendor statements directly from the vendors themselves, if possible, or review statements the company has received. These are external documents created independently of the company's own record-keeping system, which makes them valuable evidence. Auditors compare the balances shown on these external vendor statements as of the balance sheet date to the corresponding balances recorded in the company's own vendor accounts payable subsidiary ledger. For instance, if vendor X's statement says the company owes them $10,000, but the company's books only show $8,000 owed to vendor X, that $2,000 discrepancy immediately warrants investigation. It could be an unrecorded invoice, a disputed charge, a payment timing difference, but it needs follow-up. This cross-referencing helps identify potential inaccuracies in the recorded amounts, potential unrecorded liabilities, or even disputes that need resolution. And if the auditors decided to send out accounts payable confirmations, which we'll discuss next, they would carefully review the responses received from vendors and reconcile any reported differences.
Okay, completeness and accuracy seem like the big risks. What about existence? This one seems maybe more straightforward compared to the trickier completeness assertion. Do the payables listed on the company's books actually exist? Are these real debts to real vendors for real goods or services received? Or could some of them potentially be fictitious, maybe part of a fraud scheme?
You're right, existence is generally considered a lower risk for payables compared to completeness, but it still needs to be addressed by the auditors. They need to ensure the recorded liabilities are genuine obligations. The primary way auditors test existence and occurrence for accounts payable is by vouching. As we discussed when testing controls, they select a sample of recorded payable balances from the accounts payable listing or ledger. They then trace these selected amounts backward through the company's documentation trail, examining the underlying supporting documents in the voucher package. They'll check if each recorded payable is supported by a valid purchase requisition, showing need, a proper purchase order, showing commitment, a signed receiving report, showing receipt, and a legitimate vendor invoice, showing the charge. This meticulous vouching process, linking the recorded number back to tangible, validated source documents, confirms that the liability is real, is properly authorized, arose from a valid business transaction, and therefore exists.
Okay, so vouching confirms existence here too. Now, you mentioned accounts payable confirmations earlier. You said they aren't required like they often are for receivables. Can you elaborate on that?
Sure, it's a key point that often confuses people new to auditing. Accounts payable confirmations, meaning sending letters directly to vendors, asking them to confirm the balance the company supposedly owes them, are not required by professional auditing standards in the U.S., unlike accounts receivable confirmations, which generally are required unless certain specific conditions are met. The main reason for this difference is that for accounts payable, auditors usually have access to strong external evidence internally within the company's own records. Think about it. They have the vendor's invoice created by the vendor, and often a receiving report documenting physical receipt. This internally available, externally generated evidence often provides sufficient, competent evidence regarding the existence and valuation of payables. For receivables, the auditor often lacks that strong external evidence internally, like a customer's PO confirming they owe money.
Okay. Because you have the vendor's bill right there, usually.
Exactly. However, that doesn't mean AP confirmations are never used. Auditors may decide to send them if certain conditions exist that increase the risk or limit other evidence. For example, if the company's system of internal control over expenditures is assessed as particularly weak or unreliable. If the auditor becomes aware of specific vendors with known disputed amounts or unusual fluctuations, or if monthly vendor statements, which are a great alternative source of evidence, aren't available from the company for key vendors. Interestingly, if confirmations are used for payables, Auditors might intentionally select vendors with small or even zero balances according to the company's books for confirmation. Why? Because remember, the primary concern is often understatement, completeness. Confirming a zero balance might reveal a vendor who claims they are owed money, thus uncovering an unrecorded liability.
That makes sense, confirming zero to find something. But this raises that important question again. Confirmations are generally thought of as a procedure to test existence, proving something recorded is actually there. But you're saying for AP, they're often used with the objective of finding understatements, things that aren't recorded there. And you mentioned using blank confirmations. How does that work? Seems a bit counterintuitive.
You're absolutely hitting on a key nuance, and it highlights the clever design behind audit procedures tailored to specific risks. It does seem counterintuitive at first glance. Accounts payable confirmations, when used, are typically blanked confirmations. This means the confirmation letter sent to the vendor does not pre-state the balance that the company's records show is owed. Instead, it simply asks the vendor to fill in the amount they believe the company owes them as of a specific date, usually the balance sheet date. This blank design encourages the vendor to consult their own independent records and report the balance they show as outstanding, without being influenced or anchored by the balance the company might be reporting. This is incredibly helpful in potentially uncovering unrecorded liabilities. If the company's books show $5,000 owed, but the vendor returns the blank confirmation stating the balance is actually $7,000, that immediately flags a potential $2,000 understatement for the auditor to investigate.
So asking them for their number helps find differences.
Exactly. It leverages the vendor's external perspective to challenge the company's internal records, specifically targeting that understatement risk. However, as clever as blank confirmations are, they have one major critical limitation we need to remember. They can only be sent to vendors of record vendors that the company already has listed in its accounts payable system. If a liability is truly completely unrecorded, perhaps due to a sophisticated fraud, where all traces of the vendor and transaction were hidden, or maybe just extreme negligence, then there might be no record of that vendor in the system to even send a confirmation to in the first place. You can't confirm something with someone you don't know exists. So while AP confirmations, especially blank ones, are a useful tool for verifying balances with known vendors and potentially catching some omissions or understatements, they are definitely not a foolproof method for finding all possible unrecorded liabilities.
Okay, so they help, but they can't find completely hidden vendors.
Correct. But auditors have other procedures, like that search for unrecorded liabilities by looking at subsequent payments and unmatched documents to help cover that risk. And ultimately, as a practical matter, significant evidence of truly unrecorded liabilities will likely surface eventually. When unpaid vendors stop delivering essential goods or services, or when they start sending increasingly urgent collection notices or even legal threats, those liabilities tend to come to light pretty quickly. Businesses simply cannot function for long without reliable suppliers, so neglecting legitimate payments eventually impacts operations, forcing the liability to be recognized. And finally, for the accounts payable balance, auditors need to consider the assertion of rights and obligations. This essentially means confirming that the company actually owes the money recorded as payable and is legally obligated to pay it. To address this, auditors again often go back to reviewing a sample of those detailed voucher packages supporting the recorded payables. They meticulously check for the presence and apparent validity of all the key documents we've discussed throughout the cycle. The properly approved purchase requisition, showing authorized need, the corresponding purchase order, showing authorized commitment, the crucial receiving report, showing receipt of goods services, and the vendor invoice, showing the charge. The presence of this complete set of independently prepared, in some cases, and properly approved documents provides strong, compelling evidence that the accounts payable listed on the balance sheet are legitimately owed by the entity and arose from proper authorized business transactions. It confirms the company's legal liability or obligation, ensuring that the company isn't accidentally or intentionally holding itself accountable for debts it doesn't actually owe.
Okay, so that covers auditing the year-end accounts payable balance. But auditors don't just look at the ending balance, do they? They also rigorously test the transactions themselves, the individual purchases that happen throughout the entire year. Why do they do that as well?
That's absolutely right. Auditing the transactions throughout the period provides a more dynamic, ongoing view of how effectively the expenditure cycle actually functioned day to day, rather than just relying on a snapshot verification at year end. It helps assess the consistency of control application. Plus, these procedures for testing purchase transactions often serve a dual purpose. They can be performed simultaneously as tests of controls. checking if the system works as designed, and also as substantive tests of transactions, checking if the underlying financial statement assertions for those individual transactions are correct. It's efficient.
Dual-purpose testing.
Yeah.
Okay, so what kind of assertions do they test for the individual purchase transactions during the year?
They typically cover the main transaction-related assertions. For completeness of purchase transactions during the year, the auditor might, as we discussed, trace a sample of source documents like receiving reports or vendor invoices forward to ensure they were recorded in the purchase journal. They also meticulously account for the numerical sequence of pre-numbered purchase orders, receiving reports, and vouchers issued during the period, again, diligently looking for any breaks in the sequence that might indicate unrecorded or missing transactions. Regarding cutoff, which is absolutely critical for making sure transactions are recorded in the correct accounting period, impacting both the balance sheet and income statement, the auditor often compares the dates on a sample of receiving reports and vendor invoices with the dates the transactions were actually recorded in the purchase journal. More critically, as part of year-end procedures, they examine purchase transactions recorded right before and right after the balance sheet date. This is to ensure they were recorded in the proper period based on when the goods were received or services rendered, generally the title, transfer date, or service completion date. For instance, if goods were received on December 28th, but the invoice wasn't processed and the purchase recorded until January 5th of the next year, that's a cutoff error. It would understate expenses and liabilities in the year ending December 31st. Proper cutoff is vital for accurate financial reporting, ensuring revenues and expenses are matched correctly to the period for a true picture of operational performance. For valuation, allocation, and accuracy related to individual purchase transactions, the auditor might recompute the mathematical accuracy of a sample of vendor invoices selected from throughout the year. This isn't just busy work. They're often looking for common mistakes like incorrect extensions, unit price times quantity not calculated correctly, simple addition errors in summing line items on the invoice, or maybe misapplied discounts. A simple typo or calculation error on a single large invoice, or many small ones, can snowball into a significant misstatement if not caught, potentially impacting the reported cost of goods sold or operating expenses, and ultimately the company's profit. To test existence and occurrence of purchase transactions throughout the year, the auditor would typically vouch a sample of entries from the purchase journal back to the supporting voucher package. They'd test these selected transactions to confirm proper authorization was the purchase approved by the right person with the correct authority level, and verify the presence and validity of the receiving report, which provides that independent evidence that the goods or services underlying the recorded purchase were actually received by the company. This ensures the purchase transaction truly happened and was a legitimate business expense. And finally, for understandability of presentation and classification regarding purchase transactions, the auditor would verify that purchases are recorded in the correct general ledger accounts throughout the year. For example, was an expense for specialized software correctly classified as software expense and not misclassified as, say, office supplies expense? Proper classification is important because it could distort financial analysis, mislead management about where money is truly being spent, or even affect compliance with loan covenants that might be based on certain expense ratios. This ensures the financial statements are clear, informative, properly categorized, and not misleading due to misclassification.
Okay, we've covered testing controls, testing the year-end payable balance, and testing the purchase transactions during the year. That seems incredibly thorough. Is there anything left?
There's one final but very important piece of the puzzle: auditing the presentation and disclosure related to expenditures and payables. It's not enough for the auditors to just be satisfied that the underlying numbers buried deep in the company's accounting system are materially correct. Those numbers also need to be presented clearly, completely, and understandably in the annual financial statements and the accompanying footnotes that get published for external users. This is all about ensuring transparency for investors, lenders, creditors, potential acquirers, regulators, and anyone else relying on these financial reports to make informed decisions.
Ah, the footnotes. Right, so what does this all mean for the actual financial reports that you or I might read? How do auditors check the disclosures?
Auditors meticulously scrutinize how accounts payable and purchase-related information is disclosed to stakeholders. They need to ensure users get a full, transparent picture, not just a single summary number for accounts payable on the face of the balance sheet. They review this against the requirements of the applicable financial reporting framework, like GAAP or IFRS. For completeness of presentation and disclosure, the auditor ensures that all required disclosures related to accounts payable and purchases are actually included somewhere in the notes to the financial statements. This isn't just about having a note, it's about having all the necessary details. This often includes things like, for completeness of presentation and disclosure, the auditor ensures that all required disclosures related to accounts payable and purchases are actually included somewhere in the notes to the financial statements. This isn't just about having a note, it's about having all the necessary details. This often includes things like breaking down the total accounts payable balance by type. For example, separating trade payables, what's owed to regular suppliers for goods and services in the normal course of business, from potentially different categories like amounts owed to officers, employees, or related parties, like a parent company or subsidiary. These different types can carry different risks and implications. For completeness of presentation and disclosure, the auditor ensures that all required disclosures related to accounts payable and purchases are actually included somewhere in the notes to the financial statements. This isn't just about having a note, it's about having all the necessary details. This often includes things like disclosing the split between short-term payables, due within a year, and any material long-term payables. This gives a clear picture of the company's immediate liquidity needs versus its longer-term obligations. For completeness of presentation and disclosure, the auditor ensures that all required disclosures related to accounts payable and purchases are actually included somewhere in the notes to the financial statements. This isn't just about having a note, it's about having all the necessary details. This often includes things like detailing any significant purchase contracts or commitments the company has entered into, which represent future obligations not yet reflected as payables on the balance sheet. For completeness of presentation and disclosure, the auditor ensures that all required disclosures related to accounts payable and purchases are actually included somewhere in the notes to the financial statements. This isn't just about having a note, it's about having all the necessary details. This often includes things like sometimes disclosing significant expenses broken down by business segment or geographical region, if applicable. For completeness of presentation and disclosure, the auditor ensures that all required disclosures related to accounts payable and purchases are actually included somewhere in the notes to the financial statements. This isn't just about having a note, it's about having all the necessary details. This often includes things like this level of detail in the footnotes helps users understand the true nature, composition, and potential risk profile of the company's liabilities and its significant spending patterns. For completeness of presentation and disclosure, the auditor ensures that all required disclosures related to accounts payable and purchases are actually included somewhere in the notes to the financial statements. This isn't just about having a note, it's about having all the necessary details. This often includes things like for valuation, allocation, and accuracy related to the disclosures themselves, the auditor carefully reads the footnotes and other related information presented alongside the financial statements, like management's discussion and analysis, or MD&A, pertaining to accounts payable and purchases. They check to determine whether the information disclosed is accurate, presented at the appropriate, correct amounts, and is consistent with the numbers presented in the main financial statement schedules, balance sheet, income statement. For completeness of presentation and disclosure, the auditor ensures that all required disclosures related to accounts payable and purchases are actually included somewhere in the notes to the financial statements. This isn't just about having a note, it's about having all the necessary details. This often includes things like regarding rights and obligations and occurrence within the disclosures, auditors compare the information disclosed in the footnotes to other audit evidence they've gathered throughout the entire audit process. This cross-referencing is done to ensure that all information disclosed actually occurred, like a significant purchase commitment mentioned, and represents a valid right, e.g. details about specific payment terms or discounts, or a genuine obligation, for example, the breakdown of related party payables of the company. They make sure the company isn't disclosing things in the notes that don't legitimately pertain to them or haven't actually occurred. And finally, for understandability of presentation and classification in the disclosures, the auditor reads all the accounts payable and purchase-related footnote disclosures to ensure they are written clearly, are concise, avoid unnecessary jargon, and are generally easy for any reasonably informed financial statement user, even one who isn't an accounting expert, to understand. They also make a crucial judgment call. They determine whether certain items, like material long-term payables or significant non-trade payables, for instance, a large loan from a director, which is fundamentally different in nature from a regular supplier invoice, require separate, distinct disclosure on the face of the balance sheet or very prominent disclosure in the notes. This is done specifically to prevent potentially misleading financial statement users about the true nature, complexity, and potential risks associated with the company's debts and overall financial health. It ensures no one misinterprets the company's financial position or obligations due to unclear or aggregated presentation. And finally, for understandability of presentation and classification in the disclosures, the auditor reads all the accounts payable and purchase-related footnote disclosures to ensure they are written clearly, are concise, avoid unnecessary jargon, and are generally easy for any reasonably informed financial statement user, even one who isn't an accounting expert, to understand. They also make a crucial judgment call. Hashtag outro.
Wow. Okay, we just took a truly deep dive into the expenditure cycle. That was a journey. From the very moment a need arises somewhere in a department, through all those intricate and really carefully controlled steps of ordering, receiving, matching, approving, and finally pepping for goods and services, all the way through to the rigorous audit processes meticulously designed to ensure everything is transparent, accurate, and completely above board. It's definitely a complex, multi-layered system, isn't it? But it's clear now how each piece, each control, plays a truly vital role in the overall financial health and integrity of an organization.
It really does highlight just how many layers of internal control, verification, and independent checks are painstakingly built into the financial operations of well-run organizations, or at least how they should be built in. It underscores that it's not just about spending money, it's about spending it wisely, accountably, and transparently, ensuring every single dollar spent, ideally, contributes effectively to the business's goals and is properly safeguarded from error, waste, or potential malfeasance. And it's fascinating, I think, how human nature and even basic psychology are often implicitly considered in the design of these controls, like that blind PO copy, making it inherently harder for shortcuts or mistakes to happen, even unintentionally.
Absolutely. That blind copy example really stuck with me too. This deep dive really shows you, our listeners, that behind every single business transaction you see or hear about, there's likely this whole hidden symphony of interconnected processes. Processes designed not just to protect the company's assets, but also to generate reliable information for managers and external stakeholders. Understanding this, even at a high level, isn't just for the accountants or the auditors out there. It's really for anyone who wants to truly grasp how businesses operate efficiently, ethically, and how they build and maintain that critical trust with their employees, their customers, their investors, and the wider world. It's an often unseen but incredibly powerful aspect of modern commerce and good governance. So thinking back on everything we unpacked today, what stands out most to you? How does this new understanding of the expenditure cycle and maybe the brilliant simplicity behind some of its most powerful controls perhaps change your perception of how companies manage their finances and protect their valuable assets day to day?
Was there a particular control or maybe an audit procedure that really impressed you with its ingenuity or its importance? Something to maybe mull over until our next deep dive. Thanks so much for joining us today on the Deep Dive. We really appreciate you tuning in. We'll catch you next time for another journey into the fascinating world of knowledge.